Good morning. My name is Patrick William, and I'm co-founder and managing director of the Rixon Income Fund. You'll probably see my colleague Hassan Shah top left. He's coordinating Q&A, so please submit your questions via the chat function. He'll pull them together and he'll interject at opportune moments. We prepared a short, sharp agenda for this morning, and I'll aim to cover the following: addressing the issue of record insolvencies and the impact on our lending, revisiting the Rixon Income Fund mandate, presenting our current portfolio and a recent loan case study, and presenting our year-to-date results. Now, there's a fair bit of doom and gloom in the media at the moment with a focus on record high insolvencies. And there is no denying there is weakness in the economy being driven by higher for long interest rates, weaker consumer sentiment, and rising wage and input costs that cannot be fully passed on. However, as I say, the devil is in the detail. If we go beyond the headlines and you look in the articles, it's really evident that pain is being felt most acutely in three broad sectors: wholesale and retail trade, hospitality, and construction. We've pulled out the ABS data. We've presented it here for April 22, 23, 24, and it's very clear over 50% of those insolvencies are focused in those three broad sector groups. Now, that's very, very telling, and it's a very important insight for Rixon fund investors. Now, obviously, lenders in general should be cautious about lending in this space, but most notably for us, the Rixon Income Fund has a prescriptive lending mandate that is sufficiently defensive that these sectors would not meet our lending criteria, even in the best of times. Now, we'll be discussing this later in the presentation. But first, let me illustrate what Rixon does and where we sit in the domestic corporate lending funding landscape. Now, the best way to start is if you consider a hypothetical borrower, high quality business, asset rich, with strong positive operating cash flow. If that business wants to borrow more than $40 million, lucky them. The corporate institutional bank or the big four banks still play in that space, and they can get 2 or 3 really good term sheets and debt pricing at 7 to 8%. If they're looking for $15 to $40 million, there are easily 10 to 20 private credit funds in the market that target that space. So you'll get multiple term sheets, which allows you as a borrower to negotiate on price and terms. The problem arises when you want less than $15 million, and particularly less than 5. The banks don't play in that space. And if you're a $500 billion private credit fund, you're not going to spend your time on a $5 million loan. It makes no sense. So traditionally, borrowers in that space have had 2 options. Option 1 is friends and family. Very, very friendly terms. The problem is it's not institutional money. So you're not going to get a 2-year or 3-year working capital facility. You get a one-off loan for 6 months. So it's not a long-term solution. Option 2 is to hit up the family office market. Now, they're very sophisticated, they're very commercial, and they're very opportunistic. And opportunistic is the key word. So their goal is to maximize their fund return, their family office return. So they do that by giving you an institutional debt facility, but they will take 5, 10, 15% of the borrower's business in equity to juice up their final return. Now, that's not particularly compelling for a high-quality borrower, and that borrower is our target niche. We're able to provide those borrowers with an institutional, non-dilutionary funding solution, so long as they satisfy our key lending criteria. Our lending criteria or our mandate is prescriptive. There's not much leeway in it. If you look at page 14 of our information memorandum, it is very clear that all our loans must satisfy these following key criteria. Number 1, first ranking security. Heaven forbid something goes wrong with the borrower. Being first ranking means we can step in, we take charge, and we do what we require in the best interest of our investors. Number 2, the concept of real asset security. We have no interest in equity, we have no interest in intangibles or valuation reports. We require plant, property, equipment, receivables, or inventory. These are hard assets that retain value in a downside scenario that we can monetize to take our capital back. And third, we require our interest to be paid monthly in cash, and our pricing starts at 13% per annum. Now, the question people might ask is, how do you justify that level of pricing for senior secured loans on facilities that are asset-backed? And the short answer is by virtue of being the best option available to borrowers in that niche, we can extract premium pricing because we're price makers, not price takers. Are there any questions at this point?
Yes, Patrick, there's one question that's come through. Good morning, everyone. My name is Hassan, as Patrick has introduced. I'll be taking all of your questions. The one question that's come through is, does Rixon Capital have an ESG policy in place?
That's fair. Look, we don't have a documented ESG policy, but we have a shadow ESG policy. And what I mean by that is, we've got a moral compass on things we shouldn't do, but equally, we take a very commercial standpoint. So if you look at those three alphabets, you look at the E, lending to coal miners is actually a very lucrative space. You get very good LVRs, extremely high returns. The challenge there is, who do you get out to, right? If you lend to a business in that space, no one wants to refinance. You end up being trapped as a lender. So we would never lend to a business that was a polluter. With the S, similarly, right? If you've got no social conscience as a business, you're a bad credit, and you're going to struggle to exit as a lender. So that's a no. And finally, with G is a no-brainer. If you haven't got appropriate governance standards, you're not going to get through diligence. So it's a combination of a moral compass and a very commercial mindset. So by and large, I would say we do have an ESG policy. It's just not a 20-page document sitting on a drive.
Thank you, Patrick. Those are the only questions regarding the fund mandate now.
Now let's overlay this filter on those challenge sectors we flagged prior. First, you look at retail and wholesale trade. Now, they may have valuable marketable inventory. However, their revenues are discretionary and very vary month to month. So that means they cannot support monthly interest payments, which excludes them from our mandate. Then you look at accommodation and food services. Again, they too may have valuable and marketable inventory. They might even have property assets. However, earnings in this sector are volatile, cyclical, and seasonal. So that excludes us from our mandate as well. And finally, construction. Now, companies in this space that are experiencing insolvency are less likely to be asset owners, crane operators or people to run yellow goods. They're more likely to be builders and developers. Builders generally have no meaningful hard assets, and their earnings are project-based. They really don't fit our mandate. With property development, it's a speculative asset class by design, right? You buy a piece of land for $1 million, you get a DA for $100 million apartment block. You borrow $50 million and say it's a 50% LVR. But the fact is, it's $1 million piece of land with a piece of paper that says, based on today's assumptions, if all goes well, it's worth $100 million. That doesn't suit our mandate because we're focused on downside protection. So the question we're always asked at investment committee is, if this business heaven forbid goes south, how do we get our money back? With receivables, they self-liquidate. We can sell a receivables book. With equipment and inventory, you can take it at auction. But with a partially completed property development project, you're stuck. And that excludes them from our lending mandate as well. Now, if you think our prescriptive mandate requires us to be highly selective, you're right. Now, this funnel illustrates all the loans we've looked at over the last 2 years, effectively since inception, and how many we actually finance. So you look at the top of that funnel, we looked at nearly 300 loans, $2 billion worth of lending. You look at the bottom of that funnel, we funded 10 loans, less than 4% at $33 million. That's a lot of work by executive team and our investment committee to ensure we abide by our twin pillars: capital preservation, dependable monthly income, and being in compliance with our investment mandate. This table summarizes our loan portfolio as of 30th April. Now, this is disclosed monthly. All the reports are available on our website. So we take the view that offering transparency enhances the investor risk-reward proposition. We don't operate a black box. We take the view investors have a right to know what's in the portfolio, what their exposure is, and what their risk is. I want to draw particular attention to our LVR metric. That 49.9% weighted average LVR below assumes a nil equity value to our borrowers. So we're assuming the borrower business is worth nothing. All we value are those real assets that we can monetize. What people tend to forget sometimes is that debt investors, the only time we call on borrower security is when things have gone off the rails. So it's very unlikely that there's any real equity value, or if there is equity value, it's monetizable. So we focus on those real assets, that property, that plant, that equipment, those receivables. Because if you're owed $100 from BHP, well, you still due that $100 from BHP, irregardless of how your business is progressing. So that's a sort of security that gives us comfort that if things don't go well, we are getting 100 cents on the dollar back for our investors. Now, nothing beats a good case study. So here we profile one of our recent loans we did in the first quarter this year. Now, the borrower is a global student placement agency. They're based out of Australia. They've got a global footprint. Their revenue model is placing students at universities in Europe, North America, and Australia in return for a commission. So think University of British Columbia, University of London, University of Sydney, absolutely tier one counterparties. Unfortunately for the business, the universities can take up to 7 months to make payments on those invoices, which creates a substantial working capital gap. All this business needed was a $5 million working capital facility, and as you can see here, they've only taken 3. Despite having nearly $9 million in receivables from tier one universities, despite $5 million in run rate EBITDA, despite an institutional shareholder who invested $13 million early last year at a $80 million valuation, it was still too small for the banks and the big funds. So Rixon was able to provide them the facility at a 37% LVR at over 15% per annum. Now it's important to note that 37% LVR, if you look at Westpac doing home loans, they will tell you we've got a 0.5% arrears rate, a 0.1% loss rate. With this book, they've run this for nearly 10 years. 0% arrears, 0% losses. And we're sitting at a 37% LVR with a big institutional investor that has $30 million in this business. It's an exceptional return for top shelf risk.
Patrick, please allow me to interject. A question has come through.
Yes.
Countries are currently limiting the volume of overseas students. Does this present to be a risk to this loan?
That's a very good question. It's a risk to the business, but it is not a risk to our loans. So how we work with borrowers is because we require monthly cash income, we get monthly reports, and they've got thresholds around cash flow and underlying assets. So what will happen in this, so for this, using this business as an example, today they have $3 million of Rixon capital. They're at a 37% LVR, very, very substantial buffer. So let's assume tomorrow, all these countries say we're no longer taking international students. So the market effectively dies. That's a material adverse event that allows us to call default and say, look, we want our money back. But because we've got $9 million of receivables on the books that are due to be paid, all that will happen is as that money comes back over the 7 months, we will receive all our capital, 100 cents to the dollar within 7 months. So there isn't a downside risk from capital loss standpoint. It's just the fact that we'll get the money back from the loan and we'll have to look for somewhere else to deploy it. Now, over the last 12 months, we've delivered a running net cash yield of 11.4%. Now, I tell investors all the time, you don't have to be impressed by a headline return. A 10% plus return is easily available in this market, particularly given how high the base rates are. But an 11.4% cash return on a 50% asset-backed LVR, in other words, with real asset downside protection, now that is an exceptional risk-adjusted return. Because you've got to look at returns in context, right? You've got to look at the risk profile. There are funds out there doing 13, 14, 15%, no asset backing. And that's appropriate. But to get 11% on an asset-backed portfolio, that makes us an exceptional risk-reward proposition. And I'll leave you to digest this slide for a moment and can take any other further questions.
Patrick, there is one question that has come through. Is Rixon permitted to undertake related party loans?
No, expressly prohibited from taking related party loans. And if we ever did, we'd have to disclose it, which would be knocked back by our investment committee and our trust team. Look, that's a very good question, and it's a topical issue at the moment. There are a fair few new funds that have entered the market in the last 12 months. And what they do is you've got a fund manager that owns a lending business. they then they don't want to pay the high rates that we would charge, or a bank or a fund or a private credit fund would charge. So they set up their own private credit fund. They take money from investors. They promise 12, 13%. And then they lend to themselves. Now that's highly, highly problematic because at many levels. So, point one, if you use Rixon as an example, we have a borrower we're not happy with. At the end of term, we'll say, look, we're not refinancing you. We want our money back. Go away. If you're lending to a business that you own, a related party business, where you're creating 40, 50% equity returns for yourself, will you ever say no? Short answer is unlikely. The second point is you never want your fund manager, and this is very blunt, but you never want your fund manager getting rich off your money before you get your money back. And what I mean by that is, if you look at, again, Rixon Income Fund, which doesn't do related party lending, we have just shy of $40 million under management. We make a 1.5% management fee. So our job to survive as a business is to ensure the risk reward proposition suits our mandate, our returns suit our investor profile, and everything is going well. And our intention obviously is to do this for the next 30, 40 years. If you look at a business that's running related party lending, you as an investor might be receiving 13%, but you're doubling the size of the business in equity valuation terms for the fund manager in that underlying business that you're funding. So you're getting 13%, but they're doubling the size of their business. They're not particularly concerned about your risk, because if things go south, if defaults go up, their $10 million business is now worth 20, 30, 40, and they've used your capital to get very, very rich. So there's a real disconnect between risk and reward there. So I'd be very cautious about anyone out there who's raising money in a fund to lend to a business that they own. Are there any other questions, Hassan?
No other questions at this stage.
All right. Look, thank you everyone for sharing your time this morning. If you want to reach out to me, our website's rixon.capital. My contact details are on the webpage. So please reach out. I can send you an information memorandum. We can schedule a face-to-face or a Microsoft Teams call to discuss the proposition further. So we are currently raising capital. We've got a substantial pipeline for July and August. So the fund is open, so to speak. So please reach out. Thank you, everyone. Have a lovely day.